Welcome. Thank you for listening to our session on some of the key provisions contained in the CARES Act, which was signed into law on March 27th of 2020. I'm Brian Ellenbecker, one of the financial planners at Shakespeare Wealth Management, and I'll be taking you through today's presentation. In this session, we'll focus on key provisions of the CARES Act that pertain to individuals. My presentation is just an overview, though. If you'd like to discuss the new rules in more detail and how they may pertain to you, please do not hesitate to call us. We'd be happy to discuss them with you at any point. During today's session, we'll cover the following topics you see here. I'll first talk about the recovery rebates being paid to certain individuals, which was probably the most talked about aspect of this new legislation. Next, I'll move into several of the retirement plan related provisions that were included. I'll then discuss some charitable contribution provisions, and these could increase the amount that you're going to be able to deduct on your tax return in 2020. I'll highlight some of the changes to the unemployment rules, which were significant. And finally, I'll quickly review a few smaller changes to student loans and medical expenses. First, let's talk about the recovery rebates. So these are actually a new one-time tax credit that's available for people in 2020, but it's going to be repaid in advance as a rebate. The amount of this credit is $1,200 for individuals, $2,400 for married couples, and then an additional $500 for each child under the age of 17. These payments are actually expected to be sent out automatically in mid to late April. Most people won't need to do anything to receive them. However, these payments are available through the end of 2020. If you're one of the few who do end up needing to file a tax return or provide additional information in order to receive a rebate, you're going to have time to do that. You'll have time to provide that information and still receive a payment later on in the year. Rebate payments, unfortunately, are not available to everyone, though. They are phased out once your income reaches a certain level. And in this case, income is your adjusted gross income, or AGI. The payment will be reduced by 5% of the amount that your AGI exceeds, either $150,000 for joint returns or $75,000 for single returns. The credit will be completely phased out once your income reaches a certain level. So for single filers, that's $99,000 of AGI. If you don't have any qualifying children, the credit is eliminated at $198,000 for married taxpayers who file jointly. If you do have kids that qualify for a rebate, the amount of income where the credit is eliminated is a bit higher. For married filing jointly with no kids, as I said, $198,000, the credit's eliminated. Married filing jointly with one kid, that amount creeps up to $208,000. If you have two children that qualify, the credit won't be completely phased out until you're at $218,000 of income. So essentially, you can add $10,000 of income for each qualifying child that you have to the number that you see here on the slide. Now, just because you didn't get an advance payment doesn't necessarily mean you won't get anything. The credit is based on your 2018 AGI, or if you've already filed your 2019 tax return, it'll be based on your 2019 AGI. However, if those amounts are over these thresholds, but your actual 2020 income ends up being below them, you will qualify for a credit, and you'll actually be able to claim that credit on your 2020 tax return. So you won't get an immediate payment, but you will get a benefit later on, early next year when you end up filing your 2020 tax return. If you do end up receiving a rebate based on your 2018 or 2019 income that you shouldn't have gotten for whatever reason, you actually won't be required to pay that back. Conversely, if for some reason you didn't get enough as part of your rebate, you would get an additional credit when you file your return. Now, if you're unsure of how all this applies to you, because it is pretty complicated, just give us a call. We'd be happy to talk through your situation with you and help you determine how this might apply to your situation. Next, let's move into the retirement plan related provisions that are included in the CARES Act. The CARES Act added a new exception to the 10% early withdrawal penalty on retirement accounts, which is called a coronavirus related distribution. This exception applies to distributions of up to $100,000 made to what's referred to as qualified individuals. So basically, if you, your spouse, your kids, your business, the company you work for, if any of those people or entities were any way impacted by the coronavirus, you are able to take money out of your retirement account without paying the 10% early distribution penalty. Keep in mind, though, that distributions would still be subject to income taxes. It's only the 10% early withdrawal penalty that is waived under this provision. This is a very broad definition as it's currently written. So while it's possible that the IRS could narrow the scope of this definition with some later guidance, many people are likely going to be able to qualify and claim relief from the 10% penalty under this rule. Now, by default, the income that you receive will actually be reported on your taxes over a 3-year window. So 1/3 of the income gets reported in 2020, 1/3 in 2021, and the final third in 2022. You also could elect to have it all reported in 2020, which could be a good option if you expect your 2020 income to be lower. Considering the challenging environment a lot of people are finding themselves in right now, having your 2020 income be lower is a real possibility. So consider that option down the road. If you do take a distribution, you're allowed to roll back any or all of that distribution back into your retirement account over a 3-year time frame starting the day after the distribution is taken. Now, this is a very significant increase to what is normally a 60-day window to return your contributions for all other types of withdrawals. So that 60-day window is now expanded to a 3-year window for coronavirus-related distributions. Now, with all that said, we definitely do not encourage people to withdraw from their retirement accounts prematurely, except as a last resort. This money is earmarked to provide income for you in retirement, and drawing upon it now could dramatically impact your ability to retire. However, if your situation does warrant an immediate need for cash due to the difficult environment that we're in, your retirement accounts are now more accessible than they were because of this new provision. If your employer retirement plan has a loan provision, you are now allowed to take a larger loan than in the past. So the maximum loan amount is now 100% of your account balance with a cap on the loan amount of $100,000. In addition, for loans taken in 2020, repayment on those loans can be delayed for up to 1 year. Now here again, we do highly discourage 401k loans because of the requirement to pay them back is done with after-tax dollars, which results in double taxation. Because the money you return to the plan has already been taxed once, down the road, when you withdraw it again, it's also subject to income tax at that point, which is why we refer to it as double taxation. Those dollars actually end up getting taxed twice, once before they were put in and once after they were put in. So we just encourage people, don't view this rule as a pass to regular retirement accounts. You need this money to produce income in retirement down the road, so you want to make sure you preserve that unless, again, you're in a real tough spot and you need to use this as a last resort. Required minimum distributions are waived on all retirement accounts in 2020. So this includes all types of IRAs, employer plans like 401ks and 403bs, and it also applies to any inherited accounts with RMD requirements. Now, if you already took your RMD for 2020, but you didn't actually need it for living expenses or you didn't otherwise use it already, you are actually able to return it to the retirement account if it's been within 60 days of when you initially took that distribution. If you're already outside of that 60-day window, your options are much more limited. Although, if you're eligible for a coronavirus-related distribution, you could use that 3-year provision that we discussed a little bit earlier to return the funds to your retirement account and undo the transaction. Another option is if you've already budgeted for the tax liability and you're still within this 60-day rollover window, consider putting the money into a Roth IRA instead of back into the account you took it from. In that case, the distribution would still be taxable, but the investment growth on that money would be tax-free going forward. There were 2 changes that will enhance your ability to deduct charitable contributions. First, The ability to deduct up to $300 as an above-the-line deduction was added as a part of the CARES Act. So the benefit to an above-the-line deduction is that you actually don't need to itemize your deductions to get a benefit for this charitable contribution. Now, unfortunately, this deduction is capped at a relatively small amount, and it's only available to people claiming the standard deduction. But nonetheless, there is a deduction available for people that don't itemize and make charitable contributions. The second change was an increase to the AGI limit on itemized charitable deductions. The cap for 2020 was increased to 100% of AGI versus a 60% AGI for cash contributions in the prior year. A 5-year carry forward is still available for any excess contributions. Now, neither of these new benefits are available if you make a donation to a donor-advised fund or a supporting organization. The money must go directly to a charity to take advantage of either of these two things. So these new provisions are really designed to get more money in the hands of charities in these challenging times. It's less about the tax deduction and more about encouraging people to be charitable and giving that money directly to charity. Unemployment benefits have been greatly expanded in the near term under the CARES Act. The first change is the introduction of the Pandemic Unemployment Assistance Program. This allows people who are normally not eligible for regular unemployment to qualify for unemployment benefits. So individuals that could qualify under this new provision include self-employed workers, independent contractors, part-time workers, people without sufficient work history to qualify for unemployment, and even employees who quit for coronavirus-related reasons. So maybe they got the virus themselves, or they've got to provide full-time care to family members or other relatives and don't have access to paid leave. All of these individuals now qualify for unemployment under the Pandemic Employment Assistance Program. Typically, a person would not be eligible for unemployment benefits during their first week of unemployment, but the federal government has stepped in and said that they would pay states to cover that first week of unemployment. So now your unemployment benefits start day 1 of unemployment versus having to wait a week and you having them essentially start on day 8. The benefit amount that you receive under unemployment is increased by $600 per week, which is a substantial increase over the base unemployment rate. The maximum benefit for someone in Wisconsin, as an example, is currently $370 per week. So if someone's receiving the maximum benefit in Wisconsin, they're getting $370 per week. Their weekly check goes up to $970 per week. Now, it's likely that it's going to take states a few weeks to get everything ready and be able to process these new claims under the new system and the new rules. But the good news is that benefits can be filed for retroactively back as early as January 27th. Let's touch on a few other things that will impact a smaller number of people, but if they do apply to you, they could be significant nonetheless. Student loan payments can be deferred on federal loans until September 30th. And employers can now include student loan reimbursements to employees as a part of the $5,250 educational expenses that they can pay to employees that can be excluded from compensation income. So in other words, employers can pay employees up to $5,250 for education-related items, and that's excluded from the employee's compensation income. Well, student loan reimbursement is now added to that definition of education expenses. The last item, over-the-counter medications, are again a part of the definition of qualified medical expenses, and that counts for distributions from health savings accounts, Archer medical savings accounts, and flexible spending accounts. In addition to over-the-counter medications, menstrual care products are now also an eligible expense. I want to end today's presentation with a few reminders on some other recent tax law changes outside of the CARES Act that have been recently enacted. So the tax filing deadline and the tax payment deadline for 2020 was extended to July 15th. And this also includes the deadline to make your first quarter estimated payments for 2020. That deadline was also typically April 15th. That's now been moved to July 15th as well. Along with that, IRA and health savings account contribution deadlines, which were normally April 15th, have now also been extended to that same July 15th deadline. Many states had their deadlines moved automatically, as legislatively those states' deadlines are tied to the federal filing deadline. So Wisconsin is one of those states where the deadline automatically moved to July 15th. Some states, though, will have to pass legislation to move this deadline. So if you're required to file a state tax return in a state, check that state's website to be sure you can delay that filing as well. So thank you for listening to today's presentation. And again, please feel free to reach out to your financial planner at Shakespeare Wealth Management if you do have any questions on any of the provisions we discussed here today. Thank you and enjoy your day.